Those areas are over-owned right now. Everyone knows the economy is in pretty good shape, but I actually think the more defensive sectors, particularly those that are sensitive to the yield on the 10-year Treasury, are a good place to be. So REITs, utilities, telecom services, these stocks have lagged on a 2-year view, and they've also lagged year to date. And there's pretty good value there now. And we've seen what's happened in the last 3 days with the 10-year moving back below 3%. Some of these more dividend-oriented stocks are doing quite well. You get the upside that comes if rates go lower. You also get the defensiveness that comes with these types of investments.
Was there a trigger for this, Eddie? I mean, did something happen to make you think, you know what, I want to be in these sectors, which may actually be stung by higher interest rates?
Just the observation that there is such a uniform consensus around the direction of interest rates. And it's certainly an easy story to tell. The economy's in good shape. Inflation is starting to show up in the economy. Unemployment is very low. Why should rates stay around 3%? It's very easy to tell that story. But when everyone in the market believes something, things have a tendency to go the other way. So we're keeping a balanced view. We're not calling for lower rates, but we think the direction of travel from here could as easily be down as well as up. We've already had the 10-year move more than double off the bottom in terms of where rates are. Mm-hmm. So we think we're probably in a trading range on the 10-year, and therefore you're okay to own dividend stocks.
Speaking of being a contrarian here,
yeah.
I mean, if you wanted to be a contrarian, you would go into emerging markets, which could also be stung by rising rates, stronger dollar.
And then this gets back to what's going on in Italy, and to some extent, I think dollar fundamentals are not necessarily bearing out what really is going on between the European and the U.S. economies. I think there's more alignment than there is, but I do think that emerging markets, which have underperformed massively since the dollar went on this 6% move. I mean, EM's down about 7% during that time. This is how it usually trades. Not surprised to see it.
Wait, so you think the dollar should go stronger to reflect the gap between what's happening in Europe and what's happening in the U.S.?
I would put it differently. I actually think that the U.S. dollar fundamentals, without Italy blowing out on their bond yields with this coalition government, claiming they want some type of a redemption on their debt, I actually think that the dollar and euro should be trading closer to longer-term parity. I do think you have a dynamic here where I think what's going on in Italy will actually force the dollar possibly to trade higher than it should in this environment, because I think the central bank differentials, while it seems like the ECB is very much on hold, I don't think that the economies are that far apart.
Michael Jones, what would you do here?
Well, I actually think that the best story and the one that's not being told right now is Japan. I just came back from Japan, and it's very clear that the whole move to put women back in the workforce has had a profound impact on discretionary spending in the Japanese households. There's real dynamism and activity happening. You're also seeing a big move from part-time work to full-time. That unleashes an awful lot of discretionary spending because Japanese contract workers save. They don't spend. When they get full-time, you unleash a lot of spending. The fundamentals of the Japanese economy look great. The companies are putting that dynamism into their bottom line.
So how do I make that active?
Margins.
What do I do? Do I buy? Is there a Japanese ETF? You have particular equities that you like? I'm assuming you don't. Would you do anything with the bonds, which pay me nothing, and there's so many of them out there? I don't.
No, I think the bond story is just another reason to like Japanese equities. We can argue whether the massive deficits we've got to finance are going to have to push U.S. interest rates higher or lower. What you know is that Japanese interest rates are going to stay low. And that's another really positive backdrop for the Japanese equity market that we don't have here in the U.S.
All right, but bottom line, if somebody at home wants to do what you are suggesting, the best way to get into Japan is what?
So we're not allowed, from compliance purposes, to talk about specific securities, but we like to invest through ETFs. That's a diversified way.
Okay.
We also think that there is risk to the yen potentially, and that means having a flexible currency hedging strategy is also a critical component of success through investing in Japan.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.